All right, guys. So what I thought we would do now is do another example of our notes payable, because I think maybe that wasn't enough. So we're going to take this example. So if you're following along on what we have from the demonstration, this is example number 2. Okay, so if you would like, maybe pause this video and see if you can walk through this yourself. And if not, just to get an understanding of, maybe am I going in the right direction? Do I fully understand the questions that Cengage is and how they are wording the information? Okay. So it says Bennett Enterprise issued a 400,000 90-day 5% note to Spectrum Industries for merchandise inventory. So remember, we have 3 different scenarios as to why we would issue a short-term notes payable. And we've went through those before in the prior 2 videos. So read through this and maybe try to figure out who is the borrower in this particular scenario and who is the lender, right? And then also you need to ask yourself, what scenario am I satisfying? Am I borrowing from a bank? So hopefully you said no to that, because there's no bank involved. It looks like it's 2 different businesses, business to business. Number 2, is it, am I doing some kind of swap? Like I previously had an accounts payable and I'm satisfying that accounts payable with a notes payable. So hopefully in that scenario, you also said no, because it didn't give me any indication that that was the scenario. So it looks like it's scenario number 1, in which we're Bennett is the borrower, but Bennett is buying inventory on account, on like a notes payable. And maybe for whatever reason they don't have maybe established relationship, or maybe Bennett Enterprise doesn't have any credit yet, and so they're promising Spectrum Industries, hey, I'll buy this inventory from you with interest. Okay, so again, we're on scenario number 1. All right, so now we're going to journalize both of these transactions from the standpoint of both the borrower and the lender. Okay, so first we're going to start with Bennett Enterprise. Okay, so the first part is we need to journalize the issuance of the note. All right, so when we first issue any kind of note, the only thing we're recognizing is the principal amount or the amount of the inventory. Whenever you first do an entry, we never recognize interest at first, ever. Okay, so the journal entry to capture this is going to be a debit to inventory, because it looks like they're buying inventory, so they're gaining inventory in the amount of $400,000. And then my credit is going to be to notes payable, right? The reason I know it's notes payable again is because it's this information, right? They provide us with that. So that's all we have for issuance. Now they say the payment of the note at maturity. So don't forget, maturity means plus interest, right? The principal plus the interest, okay? And so it tells us to assume a 360-day year. So to do so, we need to first find out what our interest is, right? So the interest formula is just the same. It's going to be my principal amount times my interest rate times my term over my 360-day that they provided me with. Okay, so from here I need to go ahead and plug everything in. So my principal amount is 400,000 times my interest rate of 5% times my terms, times my terms of 90 days divided by 360. So don't forget, I guess, the please excuse Sally, somebody, whoever it is, right? So anyways, you have to do this part first. So you have to do 90 days divided by 360. So that comes out to 0.25. Then you do multiply it times the 5% interest times 400,000 of principal. And your amount comes out to $20,000. That sounds like a lot, but maybe it's right. All right, so your interest is $20,000. I'm gonna check it my side one more time because that seemed a little high, but I'm gonna run through it really quick. 0.05 times 400, 1, 2, 3. Okay, yeah, I figured that sounded a little high. So I was like, man, that sounds too good to be true. So what it really is, I'm sorry guys, it's $5,000, okay? So hopefully you caught my mistake or you're like, yeah, girl, you tripping. So my bad, sorry. All right, so with that, now what we're going to do is we're going to now capture what the journal entry looks like at maturity now that we know interest, okay? So to do that, I am going to make my screen just a tad bit smaller so we can capture this. And so to do the journal entry at maturity is we're gonna do notes payable because we're paying out the original amount that we borrowed, which is $400,000. We have to capture interest, so that's interest expense in the amount of $5,000. And then my credit comes out to be cash. And this is the amount that's due at the end, which is $405,000. Okay. So I'm gonna erase this, make my screen just a tad bit smaller. Okay. All right, so then it comes out to $405,000. Okay. So we have captured everything for this one. Okay, so again, Bennett is, he has no E, sorry, but he is the borrower. Okay. Okay. All right, now we're going to spin over to Spectrum. Spectrum, we know he is or she is or the company is the lender. So what they're asking us to do is to journalize the receipt. So this is more so from chapter 8, okay? So you won't have to spend a whole lot of time on this on the exam, but we'll go through it really quickly. So for them, they're going to recognize the debit of accounts. No. The debit they're going to receive is notes receivable. Okay, so I should write that out because I don't want to confuse anybody. So the debit is going to be to notes receivable in the amount of the $400,000. And then their credit is going to be inventory, right? That's what they're giving up. Okay. All right. All right. So now for maturity for them, they're in a sweet spot. They don't really have to calculate anything, or we've already done it. So if we calculate the interest on their side, then it's going to be the same thing. It's almost like a mirror image. So the debit to them, what they're going to be gaining is cash, right, in the amount of the $405,000 because that's principal plus interest. So debit cash, then they're going to credit notes receivable, right, in the amount of $400,000. And then the other credit is going to be interest revenue in the amount of $5,000. So what I really want you guys to get from this is how it literally almost it almost mirrors each other, right? So if Bennett if Bennett is recognizing a notes payable, then they're recognizing a notes receivable, right? Sorry, I should go up here. So if it's a notes payable, this is a notes receivable, right? If they're gaining inventory, they're losing inventory, right? And now when it's time to pay you back at maturity, they're paying off that notes payable and they're reducing their notes receivable. They're losing cash, they're gaining cash. This is interest expense, this is interest revenue. So it all somewhat is a blanket or a mirror of transactions for both parties. So hopefully I made that really clear to you guys. If not, as always, just reach out to me. Let me know that, hey, that didn't really make sense, or you're misspelling words. My bad. I get it wrong sometimes. But let me know if you have any questions, okay?